Well, there's a business cycle and there's a right time to sell a business. And then there's also a life cycle and a personal cycle. And there's a right time to exit the business and diversify your portfolio, have more liquidity, maybe spend your time differently than you were before. And so I think it's helpful to think through both of those separately. And when the two intersect, that's probably the right time.
This is really what an entrepreneur deserves. They've sacrificed time with their family. They've sacrificed time with friends to build an incredible business. And so when that liquidity event comes, you want to be able to support them in whatever the endeavors are that they would like to explore. And I always like to underscore the importance of bringing to the table who are making these decisions. So it's likely not just the founder themselves, it's their partner, it might even be their children, to make sure everyone's on the same page and understands the wealth and what it can do for all of them.
I think one of the simple questions you can ask somebody is, how do you want to spend your time? Do you want to spend your time running a business? Or is this the point in your life where you want to spend your time doing something else? And then you can see if the numbers are there to support something else. And then we can start doing the math in that regard.
So look, I think the perfect, if I could draw it out on paper, it'd be about 2.5 years earlier before the transaction. Because at about 2 years, you start to deal with some issues around residency planning. And residency planning is interesting. Everyone likes to talk about it, but very few people do it. Now with the billionaire tax, more and more are going to be leaving. But yeah, I think 2 years prior to the transaction, if you're going to re-residence, is probably the gold standard. And then you can kind of get closer to like a year when you're doing estate planning. And it depends on kind of what the valuation of the business is and how much has changed, and if they have, audited financials versus reviewed financials, or doing a quality of earnings. And so there are some financial aspects that have to be completed so that the investment banker can do a good job of putting together the SIM. But I would say like 2.5 years before transaction is perfect.
Founder owner coming to us, to me, most of the time, what the first question they ask is, how do I preserve as much capital as possible? Whether it be for my heirs or for myself, how do I minimize the taxes? That's usually the first question.
Well, there are advantages to doing it earlier in the process, because estate tax will ultimately accrue to the transfer of wealth from your estate to your heirs. So if you can transfer that money sooner at a lower basis, you can transfer out more before you incur that estate tax, because there is an exemption, and you want to make sure you're transferring as much as you possibly can with that exemption before a lot of that wealth accrual happens outside of your estate.
At the very least, you should start the conversation sooner rather than later. You have more options. And even if you don't do anything about it, at least you educate yourself, you learn the different approaches, and you understand what options you have at that point.
There are so many ways to move assets from generation 1 to generation 2, whether it be lending them money that they would invest, whether it be lifetime exemptions, or all the trust structures that have been created today to be able to give money to future generations. For most of my clients, I always tell them, look, caution on the side of conservative. Less is okay. You can always give them more down the road, but it's hard.
Some of these are somewhat esoteric when you think about giving away money now, doing certain kind of trusts where either it's a revocable or a non-revocable trust. So how does that all work? And I think where I've found it to be helpful is to model out some of these strategies. So taking the value of an estate and then giving some away now versus giving it away in the future, and the economic benefit for that at certain growth rates.
Probably one of the biggest decisions you have to make when you're selling your business is the team you assemble around you. It's a life-changing event. You have a great team, you probably have a better outcome.
Yeah, so in terms of the process, if we meet an entrepreneur a couple years before a sale, we work with them on setting up a revocable trust. As we get closer, we introduce them to an M&A attorney that will help them specifically with the transaction. And then from there, we go through an interview process with investment banks.
The deal attorney tends really to being the ringmaster at the end of the day, right? He's orchestrating the whole transaction, making sure the ball keeps moving down the court.
I think the most important person is the M&A attorney. They are critical in the transaction. The investment bank is very good at identifying potential buyers. but so many of deals fall apart or they succeed based on the terms that the M&A attorney negotiates.
And it's not just technical expertise and experience, it's also a fit with that client.
Technical expertise is important. I think the dynamic is the culture. He wants to feel good about these people and they have to play nice in the sandbox.
Yeah.
With each other, right? So
yeah, I mean, trust is so critical. It's critical to everything that we do. It's critical in this phase as well.
One of the things that we try and talk a lot about are the 3 buckets. Bucket number 1 is kind of running your life, which is the cash flow you need, the house you want to buy, the people you want to help vis-a-vis the transaction getting done, and what it takes to actually do that. You know, bucket 2 being gifting to the children, which is the hardest bucket, and then philanthropy, if they were philanthropic prior to the transaction. What we try and do is say, look, if we're building a model with those 3 buckets, it's probably imperative to use the low end of the range because higher numbers are always better, and that makes everything work. But what I want to arm you with as the entrepreneur is knowing what your bottom number is. Because if you get a 9 times EBITDA versus an 11 times EBITDA, does that work? And so doing all that modeling and kind of walking through the flow of funds and looking at their lives, and then really importantly, talking about what happens after the transaction.
Well, and I think we've all seen that when you have a liquidity event, people come out of the woodworks and want you to invest. And somebody's starting a pizza shop and your brother wants this and your sister wants that. Everybody suddenly knows they can look up Zillow and see what you paid for your house, and kind of the floodgates open. And how are you intelligent and thoughtful and smart about that? And I think we've done a good job of becoming the gatekeeper for a lot of these miscellaneous requests.
We spent a lot of time thinking through a plan to help diversify their portfolio, produce something that is in line with what they need long-term, with those spending objectives and their savings objectives, but importantly, protect what they built. So we always talk about being in the stay rich business, not the get rich business. And that requires you to find lots of individually attractive returns that are different and incorporate them thoughtfully into a portfolio.
I think when you have a liquidity event, it's a major shift in your life. And so this may be the first time that you don't have a consistent paycheck. You have a large sum of money sitting in an investment portfolio. And so having that shift, you have to change your mindset. And it's really important to work with a team that creates a model. We all know what the game plan is, what the milestones are, and we can adjust it as we go.
if you're investing for a family and you're doing their taxes and you're involved in their estate plan, the whole thing is integrated. So I think if you're not integrating that with your firm, it's likely you're leaving opportunities on the table.
Our business is not a cookie cutter business. Every client situation is unique. That's one thing I love about our focus on the families that we get to work with. That model has to be appropriate for that family's circumstances, and is, as I mentioned, is an evolutionary thing. So it will change over time depending on those circumstances. That portfolio that we build for that client also is going to be very much custom. It'll include a variety of investments that make sense for that family based on their objectives, their needs, their risk tolerance, their preferences around liquidity, and then what they're doing in their personal lives.
If you think about part of our role is to help clients minimize regret. If you simplify it, right? Because you just sell the business too soon. You just sell the business too late, right? Were you on the wrong part of your personal life cycle, in your family life cycle?
It's actually something that I often hear Eric talk about, which is the intimacy between the advisor and the client. And you would think that we're paid to generate, to be tax efficient and generate a good risk-adjusted rate of return. But the reality is there's kind of like what we do for a living alpha, and there's like relationship alpha. And if you don't have that connection and you're not kind of on the inside with the client, then it's hard to be a great advisor, right?